two standout auctions this week. Boy Street in Glebe, $575,000 over the reserve, and Taylor Street in Annandale, a huge $810,000 over. Now, both tightly run campaigns, smart strategy and clear buyer engagement. That's what happens when you do get the framework right, but let's not mistake that for the market trend, because while those results were stellar, they're certainly not the norm. Well, g'day folks, it's Matt Hayson here looking at everything unfolding in and around the Sydney property market this week. Now, we close off May and the numbers are now in. According to CoreLogic data, Sydney values were up 0.5%. Prop track came in a little bit weaker at 0.3%, but SQM also confirmed a slight uptick, but nothing near a surge. Now, we're seeing a cautious pace, not a rally, and here's where it gets really interesting, and it's nothing new, but it needs to be assessed. Now, according to CoreLogic auction data, at 72% late on Saturday afternoon, now that figure came out into the media before the hammer had even cooled, but SQM did the final audit on the results, and the final clearance rate came in at 49.5%. That's a 31% difference. Same weekend, same auctions, vastly different picture. So why does that matter? Because headlines like FOMO returns and buyers surging come straight off those preliminary CoreLogic numbers. And that creates the feedback loop. Sellers read it, buyers read it, and expectations start to misalign. It's perception shaping reality, not reality informing perception. Take Aidan Devine's headline in the Daily Telegraph just a few weeks back. Sydney home prices to explode post-election. Strong words, but what's actually happened since then? Well, we know now, May, 0.3 to 0.5% growth, depending on who you believe. Not exactly explosive, that's a steady trickle, not a breakout. And while we're on reality checks, the Australian economy is barely moving. GDP growth, just 0.2% last quarter. GDP per capita actually shrank down 0.2%, being the ninth decline in the last 11 quarters. Productivity's flatline, investments weak, business confidence is also soft. Now, there's even chatter that we're in a technically per capita recession, and that's why the markets are now heavily pricing in a July cut. Not because the economy's strong, but because it's actually weak. So where does that leave us all? Well, we are seeing some outstanding results, no question about that. That is a tick. When a home is well prepared, well strategized, and well handled, you can absolutely outperform. But that doesn't mean the market is roaring. It means execution now means more than ever before. We're not riding a wave, we're still carving through some very choppy waters. So if you're buying, selling, or just watching, it is vital not to get caught up in the headlines. Come and speak to the people who actually work in the market day to day. That's where the real story lives. And that takes us into this weekend, folks. It is a long one, but we're out in force and opening some amazing properties. And thanks for watching, and I'm going to catch you all next week.